Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
It is great to be here.
Today is Friday, January 30, 2026. And looking at the stack of documents we have on the desk, we are in for a marathon today, not a sprint.
It's a big one.
It is. We are not just, reading a spreadsheet. We're really here to investigate, to debate, and to synthesize the qualitative and the quantitative reality of ExxonMobil. That's ticker XOM.
And this is right after their just released Q4 2025 and, of course, the full year 2025 results.
Exactly. So the numbers are hot off the press.
They are. And I think he used the right word before. This is a pivotal moment for them. I mean, this isn't the same Exxon from 5 or 6 years ago.
How so?
Well, we're looking at a company that has, fundamentally transformed its portfolio just since 2019. They're navigating this really complex energy landscape.
One that seems, hostile in the media, but then you look at the numbers and it's incredibly profitable in reality.
That's the tension right there. And they're doing it with what I keep calling a fortress balance sheet and just record-breaking production numbers.
I want to circle back to that hostile but profitable idea because I feel like that tension defines the entire stock. But first, let's start with the 30,000-foot view.
The picture.
Yeah. Before we get the scalpels out and dissect this thing, give me the executive summary. What's the headline here?
The headline is robust. Definitely robust.
Yeah.
But, you have to put on your accountant's spectacles for just a second.
Okay.
ExxonMobil reported Q4 2025 earnings of $6.5 billion. That's on a GAAP basis.
$6.5 billion. I mean, that sounds like a lot of money to me, but in the world of big oil, is that a win? Is that a miss? What is it?
It's a win, but that GAAP number, it kind of hides the real performance. The market, the big institutional investors who are deciding whether to buy or sell this morning, they're looking at the adjusted number, the non-GAAP number.
But that came in at...
That hit $7.3 billion.
Okay, so we're already playing this game. Here are our earnings, but ignore all the messy stuff, and here are our real earnings.
It always feels like that, doesn't it?
So why should we trust the $7.3 billion figure over the $6.5 billion?
That's a fair bit of skepticism. I mean, usually when companies say, look at the adjusted number, it feels like they're trying to hide some kind of operational failure.
Exactly.
In this case, though, the difference is mostly these identified items, which we can break down in a minute. But think of them as mostly non-cash impairments.
Okay, so paper losses.
Paper losses. So if you strip those out to see the actual cash-generating power of the business, you get an earnings per share, or EPS, of $1.71.
Okay, $1.71. And what was the street looking for? What was the consensus?
The consensus was hovering right around $1.69.
So a 2-cent beat.
A 2-cent beat, yeah. It's not a blowout. It's not one of those things that sends the stock flying up 20% in a day.
No.
But it's a solid beat. It tells the market, we see your expectations, and, we can clear them, even in what was a pretty messy quarter.
You call it a messy quarter, yet I'm looking over at the shareholder return section of my notes, and messy is not the word that comes to mind. Generous, maybe?
That's a better word.
The sheer scale of the cash return to shareholders is just, it's staggering. $37.2 billion distributed in 2025 alone.
That is the wow factor of the entire report, no question.
It's absurd. Let's just try to put that in context for a second. $37.2 billion is bigger than the entire GDP of, dozens of small nations.
Right.
It's larger than the entire market cap of some pretty well-known companies in the S&P 500.
Yeah.
They're basically handing over a Fortune 500 company's worth of cash to their owners in 1 year.
And that right there, that's the core investment thesis. I mean, the analysis we're doing today isn't just, oil prices were high, so they made a bunch of money.
Right.
In fact, as we're about to discuss, oil prices actually came down in Q4. This ability to pay out so much cash is driven by what Exxon management calls advantaged assets.
Advantaged assets. Okay, I've seen that phrase plastered all over their slide deck. It sounds like corporate buzzword bingo to me.
It can sound that way.
Usually when a company invents a new term, they're either trying to hide something or brand a commodity. Are you telling me this is actually a definable metric?
It is. It's more than just marketing. Advantaged in this context really just refers to the cost of supply.
Okay.
It means assets, and we're talking specifically about Guyana and the Permian Basin, that can produce a barrel of oil profitably at a much, much lower price point than the industry average.
So even when top-line prices are bouncing around or dropping, these specific assets maintain a really fat margin.
Exactly. It's all about margin preservation.
Okay, I want to test that theory. Let's do it. Let's do the P&L autopsy. We are going to rip open Section 1, Financial Performance Highlights.
Let's get the scalpel.
Okay, so if we're comparing Q4 2025 to the quarter right before it, Q3 2025, the GAAP earnings actually dropped.
They did.
We went from $7.5 billion in Q3 down to that $6.5 billion figure in Q4. That's $1 billion of profit that just vanished sequentially. So if these assets are so advantaged, why did the profit drop?
That's a great question, and it forces us to look at the three levers that really move an oil company's P&L. You've got price, volume, and cost.
Okay.
So first, price. The report calls it weaker crude realizations.
Which is just a polite way of saying the price of oil dipped in Q4.
Exactly. And Exxon has zero control of that. They're price takers, not price makers.
Right.
Second lever, impairments. This is where that whole GAAP versus non-GAAP thing comes back. An impairment is just an accounting recognition that an asset,
An old field somewhere.
an old field in California, a piece of equipment, whatever, isn't worth what you have it listed for on the books anymore. So you have to write it down.
And that hits the GAAP earnings, but it doesn't actually burn any cash. It's a paper loss.
Precisely.
Okay, so price hurt them and accounting hurt them. What's the third lever?
Cost. Specifically, seasonally higher expenses. It's actually very common in the energy sector for Q4 to be the most expensive quarter of the year.
Why is that?
You're wrapping up maintenance projects, you're trying to finish things before the budget year ends, you're dealing with winter logistics in some places. Expenses just naturally tick up.
So, price down, costs up. I mean, that's a recipe that usually destroys earnings. Why was the drop only $1 billion?
Because of the advantage assets. This is where the thesis proves itself out.
Oh.
Despite those lower prices, the volume from those specific high-quality projects actually increased. They sold more barrels from the Permian and from Guyana.
So they made less money on each barrel because prices fell, but they sold enough extra barrels to sort of plug the hole.
Exactly right. The volume growth partially offset the price drop. If they were just a static company without that growth engine, I mean, the earnings drop would have been much, much steeper.
They're running faster, which lets them stay profitable even when the track gets a little muddy.
That's a great way to put it.
Okay, that makes sense. Let's zoom out now. Full year. Full year 2025 earnings came in at $28.8 billion. That is down from $33.7 billion in 2024. Now, if I'm a trend follower, I just see a line going down. Should I be worried about that?
I think context here is just, it's vital. You have to look at the macro environment. 2024 was a massive year for the entire industry. It was a geopolitical spike year.
Right.
So a slight cool down is not just expected, it's healthy as markets normalize. But historically speaking, earning $28.8 billion in a normal year, that is massive. We're talking top-tier profitability that rivals some of the biggest tech giants.
Okay, let's circle back for 1 second to those identified items, the messy stuff.
Yeah.
We said they negatively impacted Q4 earnings by about $0.8 billion. You mentioned impairments. Anything else hiding in there?
It was primarily impairments, about $1.1 billion worth. There were also some restructuring charges, paying out severance, reorganizing some teams. But those negatives were offset a little bit by divestment.
Divestment, so that's selling off the junk, the non-core assets?
Correct. Selling non-core assets. And there were a couple of favorable tax items in there as well. But really, the bulk of the drag was simply cleaning up the balance sheet value of some of their older assets.
Got it. Okay, let's talk about the real lifeblood.
Right.
Because earnings, they're an accounting opinion. Cash is a fact.
Cash is king.
Let's look at the cash flow.
Cash flow from operations, or CFO, was $12.7 billion in Q4 alone. For the full year, it was $52.0 billion.
$52 billion. I mean, let's just pause on that number. That is $1 billion a week.
$1 billion a week.
Every single week of 2025, Exxon generated $1 billion in cash just from its operations.
It's a cash machine. And really, the more important number for you as an investor is free cash flow, FCF.
Right. What's left over after they pay for everything?
Exactly. After they pay for all the drilling, the rigs, the new platforms in Guyana.
What's left?
And that was $5.6 billion in the quarter.
And all this cash generation feeds right into the balance sheet. Management used that phrase, industry-leading balance sheet. Net debt to capital is at roughly 14%. Why is 14% the magic number? Why not 0 or 30%?
14% is a critical sweet spot. In this industry, commodity prices are just incredibly volatile. I mean, they can crash 50% in a few months.
We've seen it happen.
We have. If you have high debt, say 30 or 40%, and oil crashes, your interest payments will eat you alive. You have to fire people, you have to cancel projects.
You have to cut the dividend, which is the cardinal sin for an oil major.
That is the cardinal sin. So by keeping debt low, at 14%, they have what they call flexibility. It means they can invest through the cycle.
Okay, explain that phrase, invest through the cycle. What does that mean in practice?
It means that when oil crashes and all their competitors are panicking and canceling their drilling rigs, Exxon has the cash reserves and the low debt to say, no, keep drilling. And this lets them hire services cheaper when the market is down, and then they have new production ready to go when the market inevitably recovers. They don't have to make these jerky reactions to short-term price movements.
It's like the difference between living paycheck to paycheck and having a year of savings in the bank. You just make better long-term decisions.
Precisely that.
So they have the cash. Now, let's talk about where it's all going. Section 2, shareholder returns. We mentioned that huge $37.2 billion annual figure. Let's look at Q4 specifically. They returned $9.5 billion in just 3 months.
It's incredible. And the split is really interesting. $4.4 billion of that went to dividends.
Okay.
But $5.1 billion went to share buybacks.
So they're actually spending more on buying back their own stock right now than they are on the dividend.
They are, and there's a very specific strategic reason for that, and it's linked to the Pioneer Natural Resources acquisition.
Ah, yes. The Pioneer factor. I remember that massive deal. What was it? $60 billion to buy Pioneer? It closed back in May of 2024.
That's the one.
That was the moment Exxon basically doubled down on the U.S. shale patch.
It absolutely was. And crucially, it was an all-stock deal.
Meaning they didn't pay with cash. They paid Pioneer shareholders with new Exxon shares.
Exactly. They printed new Exxon shares and handed them over to the Pioneer owners. And this causes what's known as dilution.
Right.
If you owned Exxon before the deal, your percentage ownership of the company got a little bit smaller because the total number of shares just increased. Investors, they generally hate dilution.
Of course. It's like slicing the pizza into more pieces. My slice just got smaller.
That's the perfect analogy. But here's the key stat that should make current shareholders very happy. Exxon has already retired shares, equivalent to 1/3 of those that they issued for the Pioneer transaction.
Wait, already?
Yeah.
In less than 2 years?
Yes. They are aggressively, and I mean aggressively, shrinking the share count. They're buying back stock specifically to offset that dilution and boost the earnings per share. It's a very, very rapid pace of retirement.
That is impressive. I mean, it shows they're serious about protecting that shareholder value proposition. They're not just empire building. They're trying to maintain the value of the currency, which is their stock. And on the dividend side, we have to mention the streak.
Oh, yeah. 43 consecutive years of annual dividend per share growth. They're the second largest dividend payer in the entire S&P 500.
43 years. I mean, that goes back through the pandemic, the 2008 financial crisis, the dot-com bubble, the 1980s oil glut.
It signals a culture where that dividend is sacrosanct. Management knows that a huge chunk of their investor base holds the stock solely for that income. Breaking that streak is just not an option unless the company is facing some kind of existential threat.
Okay, so we know they're making money and they're giving it to us. But how are they making it? Let's get into the gears and the pistons. Section 3, segment analysis upstream. This is the growth engine.
It is. And the headline here is just one word: production. They have the highest full-year production in over 40 years. 40 years. 4.7 million oil equivalent barrels per day. You'll see that abbreviated as MOBID.
4.7 million barrels a day. It's just hard to visualize that much liquid. But this isn't just about, pumping old wells dry in West Texas. This is being driven by what they call the Big Two. Let's start with the domestic giant, the Permian Basin.
The Permian is a beast. I mean, they hit record production of 1.8 MOBID in Q4.
Yeah.
But what's really fascinating here isn't just the volume, it's the technology. This isn't the Wild West oil drilling of the past. It's more like manufacturing.
I saw mentions of cube development and lightweight proppant. I mean, these sound like heavy technical jargon, but I get the sense they're kind of the secret sauce here. Can we demystify cube development?
Absolutely. So in the old days of shale, you'd drill a well, you'd frack it, and then you'd move the whole rig. It was like mowing a lawn, one strip at a time.
Yep.
Cube development is like building a skyscraper, but underground. Exxon will sit on a single pad and drill multiple wells simultaneously, sometimes 10, 20 wells, targeting different layers of rock at different depths all at once.
So they're hitting the Wolfcamp A layer, the Wolfcamp B, the Spraberry, all from the same spot at the same time.
Exactly. It minimizes all that time the rig spends moving around. But the real challenge, the genius of it, is pressure management.
How so?
If you drill one well, it changes the pressure in the rock around it. If you come back and drill another one nearby a year later, you might lose pressure and ultimately lose oil. By doing it all at once in the cube, they can manage the pressure of the entire reservoir block, which maximizes the recovery.
It sounds like a logistical nightmare.
It is. And it's something only a major with massive amounts of capital can really pull off effectively.
Okay, so cube is about scale and logistics. What about lightweight proppant? Is this just some kind of special sand?
It's a game changer. It really is. It comes down to physics. Think about a standard fracking operation. You're blasting water and sand deep underground to crack the rock open. The sand, which is the proppant, is supposed to wedge itself into those cracks and hold them open so the oil can flow out.
Right, standard procedure.
The problem with standard sand is gravity. It's heavy, so it tends to sink and settle at the bottom of the crack near the wellbore.
Okay.
That leaves the tips of the cracks, the furthest reaches of that fracture network, unsupported. So they close back up, and you lose all that oil. You leave it in the ground.
So you're literally leaving money in the ground because your sand isn't buoyant enough.
Exactly. So Exxon has shifted to lightweight proppant. It's essentially a ceramic or a specially treated material that's buoyant enough to float deeper into that fracture network. It distributes more evenly.
It's not just sand, it's an engineering solution to a physics problem.
Precisely. They used it in 25% of their wells in 2025. And they're targeting using it in 50% of their new wells by the end of this year, 2026. It lowers costs and it improves the yield. It's how they squeeze more blood from the stone.
So they're getting better and better at fracking. Now, the bear case on the Permian is always, it's peaking. You hear people say the best rock, the Tier 1 acreage is gone.
Exxon management was very defensive on this point during the call and very data-driven. They said there is no peak Permian in the near term for them.
And they're projecting growth.
They're expecting to get to over 2.5 million barrels per day beyond 2030. Because of that pioneer acquisition, they have an inventory depth that spans decades.
Okay, so the Permian is the steady manufacturing plant. Now let's go to the frontier, Guyana. This has been the golden child of the oil industry for a few years now.
It really has. I mean, gross volumes there are already approaching 875,000 barrels per day.
That is just massive for a country that wasn't even producing oil a decade ago.
It's an unprecedented speed of development in the history of offshore oil. And the execution is what really stands out. The Yellowtail project, which is their fourth development there, started up 4 months ahead of schedule and under budget.
Okay, stop right there. Ahead of schedule and under budget. In offshore oil.
I know.
That almost never happens. Usually these things are late, they're plagued by weather delays, they run billions over cost. How is Exxon doing this?
It's this philosophy of design one, build many. Instead of designing a completely custom ship for every single oil field, they created a standardized design for the FPSOs.
The floating production, storage, and offloading vessels.
Right. So they build the hull in one shipyard, the topsides in another, and they fit them together almost like Lego blocks. They're just replicating success over and over rather than reinventing the wheel every time.
And once the ship is out there and running, are they getting the production they expected?
They're getting more. The first 4 FPSOs are producing a combined 100,000 barrels a day above their original investment basis.
Wow.
This is a process called debottlenecking. They get the ship running, and then the engineers on board start tweaking the pumps, adjusting the separators, and they realize, hey, we can actually push more flow through this system.
And that is pure profit falling straight to the bottom line. The capital is already spent. Those extra barrels are essentially free.
That's it. It shows they're learning the reservoir and optimizing the facilities in real time.
And quickly, Brazil. It's often overshadowed by Guyana, but it's a major play for them.
Yes, the Bacalhau development started up in Q4. This is Exxon's first offshore Brazil development, which is a big milestone.
And it's important for diversification, I imagine.
It is. It diversifies the risk. If something political were to happen in Guyana, they've got Brazil coming online. It's another arrow in the quiver.
So Upstream is booming, record production.
Yeah.
But Exxon is an integrated major. That means they refine the oil and make chemicals, too. So let's look at Section 4. Energy products, chemicals, and specialty. Let's start with energy products. This used to be called downstream, right? Refining and fuels.
In this quarter, energy products was the savior.
The savior? How does the boring part of the business save the quarter?
Well, think about the mechanics. Upstream earnings dipped because oil prices fell. We established that.
Right.
But energy products earnings jumped to $3.4 billion in Q4. That's up more than 80% compared to Q3.
So when oil gets cheaper, the refineries make more money. Is that how it works?
Generally, yes. It all comes down to something called the crack spread.
Okay, you're going to have to explain that for the listener who doesn't stare at refinery margins all day.
Of course. Think of the crack spread like a baker's profit margin. The refinery is the bakery.
Okay, I'm with you.
Crude oil is the flour. Gasoline and diesel are the loaves of bread. If the price of flour, the crude oil drops, but the price of a loaf of bread gasoline stays relatively high because people are still driving.
The baker's profit margin widens.
It widens, exactly. That's
Yeah.
a perfect visualization.
So in Q4, their input costs fell, but the demand for the finished product, gasoline and diesel, held up.
Precisely. The margins widened, and on top of that, they had record throughput.
Throughput meaning the amount of oil they actually process through the refineries.
Yes, they hit the highest annual global refining throughput on a same-site basis since the ExxonMobil merger.
Wait, since the merger, that was back in 1999.
1999.
That's an incredible statistic. It means their plants were just running full tilt all year.
It is, and it really highlights the value of that integrated model. This is why Exxon argues they are a safer bet than a pure-play driller. When oil prices fall, yeah, it hurts the upstream division. But lower oil prices often mean better margins for the refineries.
Which helps the energy products division. It's a natural hedge.
It is. It acts as a shock absorber. It smooths out the earnings volatility for the company as a whole.
Okay, so that's the shock absorber. But not everything is rosy. Let's talk about the problem child this quarter. Chemical products.
Chemical products is definitely the laggard right now. Q4 was a loss of $281 million on a GAAP basis.
Ouch.
And even if you strip out those identified items, it was still barely break even at negative $11 million.
Negative earnings. A company this sophisticated is losing money making chemicals. What on earth is going on there?
It's what the industry calls bottom-of-cycle conditions. The chemical industry globally is just massively oversupplied right now.
Meaning too many factories and not enough buyers.
Exactly that. During the pandemic and shortly after, everyone projected this massive demand growth for plastics and chemicals. So everyone, Exxon, Sinopec in China, Dow, they all built massive new plants.
And now they're all online.
Now they're all online, flooding the market with product. And that just crushes margins for everyone.
And I saw a specific note about their China chemical complex.
Yes. So they're in the process of ramping up a massive new facility in China. And when you're in that startup phase, you have higher spending, but you're not at full efficiency yet. So that was a specific headwind for them this quarter.
Is there any kind of silver lining for chemicals? Or is this just a waiting game for the cycle to turn?
There is a strategic silver lining. They reported record sales of what they call high-value products.
Okay.
So these aren't your basic commodity plastics for, water bottles. These are performance chemicals. For example, they just tripled their capacity for something called Proxima resins.
Proxima. Sounds futuristic. What is it?
It's a high-performance resin. It's used in things like advanced packaging and automotive parts. It's lighter, it's stronger, and it cures faster than traditional materials.
So a high-margin product.
A very high-margin product. So what they're doing is positioning themselves so that when the market turns, and it's a cyclical industry, so it will turn, they will have the capacity in these high-margin specialized products to really capture the upside.
So they're using the downtime to upgrade the quality of the portfolio. Makes sense. Okay, let's pivot to the big picture. Section 5, Strategic Execution and Management Commentary. CEO Darren Woods gave some opening remarks that really tried to frame the narrative.
He did. He emphasized this fundamental shift in the company since about 2018. He called it a transformation. And the core of that claim really comes down to structural cost savings.
Okay, I have to be the skeptic here. We hear companies talk about cost savings all the time. We cut the travel budget. We switched coffee brands in the break room. But they use that specific word, structural. What makes a cost saving structural?
That's the key distinction. Structural means it doesn't come back when the good times return.
Okay.
If you cut the travel budget, that expense comes right back when profits are up. Structural means changing how you fundamentally work. It means consolidating 3 different supply chain departments into one global center. It means automating a manual process with AI. It's a permanent efficiency gain.
So give me the number. What's the impact?
$15.1 billion in cumulative savings since 2019.
$15.1 billion. That's just straight to the bottom line.
It is. And they're not done. They're targeting approximately $20 billion in total savings by 2030.
So what does that do for the company? Why should an investor care if they save money on paper clips and logistics?
You should care because it lowers the break-even price of oil for the company. This is probably the most critical metric for safety. CFRA research estimates that Exxon can now protect its dividend even if Brent crude drops all the way to $50 a barrel.
$50 a barrel, and right now we're sitting well above that.
Correct. It means that dividend is safe in almost any realistic downside scenario. Even if a nasty recession hits and oil demand slumps, Exxon can keep paying you. That is the fortress balance sheet in action.
Okay, let's talk about some projects. We mentioned the Brazil startup, but there's a big one coming online in the U.S. right now. Golden Pass LNG.
Liquefied natural gas. Yeah, this is a massive export terminal down in Texas. Train 1 has achieved what they call mechanical completion. They expect the first cargoes to ship in Q1 2026.
So that's imminent, like literally now.
It is. This is a huge strategic play to take abundant, cheap U.S. natural gas, freeze it into a liquid, and ship it to Europe or Asia, where gas is much more expensive. It's capturing the arbitrage between U.S. prices and global prices.
And what about the low-carbon solutions business? This is the controversial part for some, the necessary part for others. Is it just greenwashing, or is it a real business?
They are definitely trying to make it a real business. They have 9 million tons per annum, or MTA, of CO2 under contract with third parties.
So what does that mean?
It means other heavy industries, like steel plants or fertilizer makers, are paying Exxon to take their carbon emissions, transport it via pipeline, and bury it deep underground.
And there was a fascinating question during the Q&A from analyst Sam Margolin about lithium. What is an oil company doing messing around with lithium?
It sounds odd at first, doesn't it?
Yeah.
But when you hear the logic, it's actually a brilliant synergy. They're not mining rock for lithium.
Okay.
They are extracting lithium from brine, super salty water that's already deep underground in Arkansas from some of their old fields.
So it's a liquid extraction process, not a mining process.
Exactly. And management explained that this leverages their core subsurface skills. I mean, who knows more about drilling wells, pumping fluids, managing reservoir pressure, and handling brines than a company like Exxon?
That makes perfect sense.
It turns out lithium extraction from brine looks a lot like oil and gas extraction from a skills perspective.
So if you're good at drilling holes and managing fluids, why not use that to pump up a battery metal?
That's the logic. And they see synergies with their carbon business as well. Look, it's a small part of the portfolio now, but it's a smart hedge on the energy transition. They're trying to become a molecule management company, not just an oil company.
And before we leave this section, a quick note I saw for the retail crowd. They announced a new investor relations update.
Yes, launching February 2, 2026. A brand new individual investor webpage. They explicitly recognize that 40% of their shareholder base is retail.
40%.
40%. It's individual folks like our listeners, not just big hedge funds in New York.
That is a staggering number. Usually for giants like this, it's 80–90% owned by institutions. 40% retail is huge.
It is. It speaks to the brand loyalty and that dividend history we talked about.
Right.
And they're realizing they need to communicate more directly with those people, not just issue these dense PDFs for Wall Street analysts.
Okay, that's what the company says. Let's look at how the street sees this. Section 6, market comparison and analyst views. We've got a report here from CFRA Research. What's their verdict?
CFRA gives it a BUY rating.
And the price target?
$142. And with the current price hovering right around $140, that suggests they see it as, fairly valued, but a solid hold for the total return.
And what about valuation-wise? How does it look?
It's trading at roughly 7.0x EV/EBITDA. That's enterprise value to EBITDA.
Is that expensive? Cheap?
It's reasonable. It's a little bit above their historical average, but CFRA argues it deserves that premium because of the structural cost improvements and the sheer quality of the asset base now.
And they talk about a competitive moat. This is interesting because just a few years ago, people were calling Exxon a dinosaur for sticking to oil while all their European peers went green.
That is the great irony, isn't it?
Yeah.
CFRA explicitly notes that Exxon stuck to its knitting with fossil fuels while peers like BP and Shell pivoted hard into renewables. And now, those peers are reversing course because the returns on renewables were, frankly, poor.
Yeah.
Exxon's strategy, which was criticized, now appears to be vindicated. They stayed in their lane, and they made a lot more money doing it.
The tortoise and the hare, perhaps? Or just the stubborn giant being right all along?
And the numbers really back it up. Exxon's return on assets is 6.2%. The peer average is 4.4%.
That is a significant gap. That implies that for every dollar of equipment they own, rigs, refineries, ships, they generate almost 50% more profit than their rivals do.
Roughly, yes. And look at this number. Upstream operating earnings per barrel. In Q3, Exxon earned $12.94 for every barrel they produced. Chevron, their biggest U.S. rival, earned $9.39.
Wow. So for every single barrel they pull out of the ground, Exxon keeps an extra $3.50 more than Chevron does.
That is the advantaged asset story in a single number. That's a Guyana. That's the Permian at work.
But, it's not all sunshine and rainbows. We have to look at the risks. What could kill this thesis?
Commodity price sensitivity is always number one.
Right.
I mean, if oil drops below $50 and stays there for a long time, say due to a massive global recession or a much faster than expected shift to EVs, the math gets much, much harder.
The buybacks would stop.
The buybacks stop, the growth slows. It's a different story. Then there's always the regulatory and political risk. The speed of the climate transition, carbon taxes, potential regulatory crackdowns on fracking. These are the long-term existential threats.
Exxon is betting the transition is slow. If it accelerates, they're exposed?
Very exposed. And a near-term risk is that chemicals recovery. How long will this bottom of the cycle last? If it drags on for 2 more years, that's a billion-dollar drag on earnings every single quarter.
Okay, we've covered the numbers, the segments, the strategy, and the analysts. Let's bring it all together. Section 7, synthesis the so what for the listener. If I'm holding XOM stock today, or I'm thinking about buying it, what does 2026 look like?
The outlook is steady, methodical growth. Production is going to continue to grow, and it's going to be driven by those 2 engines we talked about, the Permian and Guyana. The cost of supply will continue to drop because of that technology and efficiency. And importantly, the share repurchases are set to continue.
At that $20 billion per year pace.
Assuming reasonable market conditions, yes. And that puts a massive floor into the stock price. It's hard for a stock to crash when the company itself is in the market buying $50 million worth of it every single day.
I want to debate this advantaged asset concept one last time because it really feels like the core of their entire pitch to investors.
It is. The definition is crucial. It's assets with a lower cost of supply and a lower carbon intensity.
Wait, lower carbon intensity? How is oil low carbon?
It's relative to the alternative. A barrel of oil from Guyana produces fewer emissions to extract and process than, say, a barrel of heavy oil from the Canadian oil sands. So they argue it's a cleaner barrel of oil.
I see. So the argument is, if the world is going to need oil for the next few decades, they want to be the one providing the cleanest dirty barrel.
Precisely. And the trend is the whole story. In 2025, 59% of their production came from these advantaged assets. That's up 7% from 2024. As that percentage climbs towards 70–80%, the company just structurally becomes more profitable per barrel.
So they're high-grading the entire business, selling the junk, keeping the gold, and investing in more gold.
That's it, exactly.
All right, this has been a really comprehensive look at the beast that is ExxonMobil. We've seen the record profits, the massive shareholder returns, and this really clear strategic bet on efficiency and fossil fuels.
It's a company that's firing on all cylinders, and it's surprisingly nimble for its enormous size.
So here's a final provocative thought for you to chew on as we wrap up. Exxon is betting the farm that the world's thirst for oil isn't going away anytime soon, and they are doubling down on being the most efficient, lowest-cost producer of it. With their competitors flip-flopping on strategy, does XOM's consistency make it the safest play in a very volatile sector? Or does it leave them the most exposed if the energy transition suddenly accelerates faster than anyone expects? Are they the last man standing, or are they the last one to leave the party?
That is the multi-billion-dollar question, isn't it? And it's one that every investor in this space really needs to answer for themselves.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.